This is Distillation Dance 5.5. This is going to be the addendum and/or the recap to the stock market video. We're going to talk about the implications of the stock market video a little bit, and we're going to also talk about how this ties into things such as stock price, cryptocurrency, and which companies succeed and fail. All right. So, quick recap. Company A is a company that decides they're going to sell lemonade. Company A decides it wants to expand. In order to expand, it needs to grow some money, and money does not grow on trees. Therefore, it needs to get the money from somebody. Gets the money by way of either bonds, meaning they promise that they're going to pay back somebody for the use of their money a certain percentage, whether it be 5, 10, 20%, whatever the bond yield is. The other thing they do is that they sell part of their company, and how they sell part of their company is through stock. Stock is the thing that signifies ownership in the company. There's a certain amount of stock of the company. Let's say the company has 1,000 shares of stock. Then the person who owns 501 shares actually owns 50% ownership of the company, aka majority ownership, and has the deciding vote or say in what the company does. Whether or not the company decides to move to California or move to Colorado, for example, if it comes to a vote. Now this company that decides to sell the shares to go public now has to go through the banking system or the Federal Reserve banks or the New York Stock Exchange banks in order to get onto the New York Stock Exchange and or NASDAQ. The stock exchanges, whether they be NASDAQ, New York Stock Exchange, OTC, Pink Sheet, whatever, allows the company to sell these shares through an underwriter to the public. So they sell part of ownership of their company to the public. And the people that buy these are either the institutions, these multi-million, billion-dollar corporations that aggregate money and use that money to produce profit or produce money for the money, and your individual people who are your investors, or the old guy at 55 who has his 401k, or the young guy at 20 who decides he's going to go ahead and put in some money to the stock market to invest and explode his money or explode his account, whichever one. You take this money that goes into the stock market, and the bank or the institution is the one that gives this valuation to the stock. So they say your company, based on the fact that it has X amount of profit or X amount of debt and these amount of assets, we're going to give you a valuation of, let's say, $5 to $10 for your company, and your company is going to start selling those shares at that value, and based on those shares being sold, you're going to raise X amount of money. So let's say there's 1,000 shares of the company, and they decide they're going to sell 30% of those shares at 300 shares, and those shares are at $5. That company is now able to raise $1,500. With that $1,500, they can now continue to use that money to grow their company, and those 300 shares, or that 30% ownership of the company, is now in the hands of whichever investor has bought them. From there's a way that the stocks are actually played out, and basically big money is the one that controls the way that the stock moves up or down, because your small money or your individual investors don't have enough money to move the price as much as they would like to think they do. So the laws of supply and demand don't really apply, because the supply is artificial and the demand is artificial, and somebody else is in control of the price action by way of having larger money. It's basically the big money at the poker table. Big money at the poker table determines whether or not people have to go all in order to even risk the bluff. That being said, there are multiple avenues of stock ownership and stock movement. The stock movement is, they can sell or they can buy, and they can move the price by way of that. And there's also short selling, which is selling while owning the stock, and then you buy it back and then give the stock back to whoever you owned it from. And Basically, you can sell without owning, push the price down. Selling generally pushes the price down, buying generally pushes the price up, generally speaking. And by doing so, they control the prices in the markets and they determine whether or not they want to make profit doing this. Because if they buy it at $1 and sell it $10, it's $9 of profit. It's a home run. You see stocks that will be 50 cents one day and $100 the next day, right? Not really that drastic of a change, but things that you hear about, those overnight successes, at which point these companies have these institutions have probably already bought up really low at under $1 and are now selling back to people at hundreds of dollars, or in the case of Tesla, thousands, right? Tesla, Apple, Google, Amazon, you know and that's the basis of how the market works. Big money says what goes on, and big money determines whether or not you even get to put your money in the stock market, whether or not your company even gets on the stock market. Congratulations, you've been played. All right, implications of this. Let's go back to the parable of the bucket maker. Because of this, the institutions, whether it be the banks, determine whether or not a company has enough money to go forward. So not only do the banks have the opportunity to offer the loans to these companies that will give them enough money to continue running their company until they're profitable, or as they raise their profits. But these banks now also have the ability to determine whether or not this company can raise money on the public market, meaning, unless they're going to go out and do fundraiser, and fundraisers aren't very, very successful for companies most of the time, they have to either sell bonds or stock. And yes, in order to sell these bonds and stocks, somebody has to underwrite them, namely a bank. And these underwriters determine the valuation of that company. Meaning that if I decide to sell my lemonade company, the bank is going to be the one that tells me how much I can sell these shares of my company for market value. Then once they get on the open market, then they get determined by these institutions who determine the same thing. And these institutions are basically banks and the money holders for the banks. And in such a way, every single piece of value that you think is in the market, while it may be slightly related to some kind of fundamental value, or the enterprise of the company, or what the company has on assets, these values are very much determined by these institutions. I have seen companies with assets worth billions be valued as per the market valuation of their stock price in millions. And what this means is that because someone else is determining the value of each company, whether or not the company is doing good or bad, for the human race as a whole, doesn't matter. What matters is whether or not Wall Street says that the company should succeed or not. Let's take, for example, some of these companies. There's a company right now called Progenity. Progenity is a biotech company, and they are creating smart pills that literally you swallow and they go into the intestine, and they can either take samples of the tissue in the intestine, or they can be used to provide injections directly to the intestine for problems like Crohn's disease, ulcerative colitis, etc., etc. This company, Progenity, because Wall Street has not deemed them to be heavily valuable yet. We're talking smart pills that can literally deliver medicine directly to a certain part of the human anatomy, which compared to the current medicine, which is injections, which have to be given and still end up in the bloodstream and don't go directly to where they need to be, which means the injections lose a lot of their efficacy compared to the pills that are targeted. This company is currently less than $1 a share. But you go, but why? This is something that could change the way medicine is treated for the rest of the world. Yes, but someone in Wall Street says this company is not successful enough for them to put money behind it yet, and that's all there is. Now, granted, this company is lucky that it even made it onto the stock market, because when it comes to things such as biomedical companies, cures for diseases, advancements that help humankind, these things are affected by the way that money works. In short, unless somebody's willing to put money behind an idea or let the company go public, It doesn't matter if your car drives itself, runs on diesel, gasoline, toilet water. It's whether or not you can get enough money to A, run the company, and B, push that company forward or get through the manufacturing phase into an actual profitable phase of your company. And the people who determine this are the banks. So let's say you go to a bank and you say, hey, I have an idea for a company that's going to revolutionize the world, and I'm going to, make it such that electricity costs 1/3 of what it currently costs, right? Well, this bank looks at you and says, hey, that's a great idea, but yeah, I'm not going to put money behind that. Well, what you don't know is the bank actually has 50% ownership in the power company where you live, and you changing the power structure will actually negatively impact the bank's bottom line because their investment will go down in value. So they don't want that to happen. So they don't give you the money, and your company just flops. Congratulations. 20 years later, you find out that your money, that your invention is now being used by the power company to develop 3 times the energy while keeping the cost the same, and the bank is raking in the profits. What happened? Well, you can say that you had your idea and it was patented, and patents have a limitation on time before they can be copied, obviously. And the bank that you went to for money quite literally stole your idea out from under you, but you had to tell them what your idea was because you were looking for funding, and if you don't tell them what the idea is, they're not going to give you the money. Yeah. Same for any company that goes into Wall Street. You go ahead and sell a certain amount of shares of your company, and then they get voting rights, and they get to tell you whether or not you're going to continue what you're doing. So if you're a medical research company, the people who own your company get to tell you whether or not you can continue on that research, or you should focus on something else that they want you to. The money is what controls everything at the end of the day. Now let's take this and go towards the idea of Bitcoin and cryptocurrency. Bitcoin was initially created as a way to store value that did not require the American dollar. It was supposed to be anonymous, and it was supposed to be something the government couldn't track, the government couldn't control. Well, the problem there is, in order for Bitcoin to be adopted into the general public, everybody would have to have spent money on Bitcoin and not thought of it as a fad. But what happened is that the institutions and or the banks, read as the bucket maker, went ahead and they decided that they were going to tell people it was a bad idea, that Bitcoin wasn't safe, and then while doing that, while suppressing the price of Bitcoin, then they would go in and jump in and buy up Bitcoin, because there is no way that individual people can push the value of Bitcoin up to $20,000. It doesn't happen. The amount of purchasing that has to occur is on the order of millions and billions of dollars, which the average person does not have to throw at an investment that may or may not pay out in a couple of years. Now, what these banks do is they push the price up, Bitcoin's almost $60,000. Then, what they do is they go ahead and crash Bitcoin. By crash, I mean sell out at the top, because they now pulled their money out of their investment. But note that Bitcoin's current price is after they've sold out and, left people holding it back. Same for almost any cryptocurrency. No cryptocurrency is safe, because in order for something to be successful, there has to be money put behind it. The people that control the money are the people that control the success of any given thing. It's the same thing for, let's say, a songwriter, right? A songwriter could be an amazing songwriter, but unless there is somebody behind them that is pushing their content out, that is pushing their singles and publicity and advertising, which requires tons and tons of money. If you look at the Super Bowl commercials, which cost millions of dollars for a 30-second spot. In order to get eyes on your thing, which leads to potential income, you need money. It's the same basis behind, your politicians. In order to get money behind anything, it requires, in order to get any kind of traction, you can be the best politician out there, and this is going to be another topic for another time, but you can be the best politician out there. You can really want what's best for your people, but if you don't have any money behind you, you will never get elected. You will never be successful, because someone, namely the bucket maker, namely the crafty blacksmith, is saying that you do not have the value or you're not worth them putting the value into you, the investment into you. Whether or not that is true from an organic standpoint, uh, logical standpoint, you can have the cure for AIDS. Your company can be researching the cure for AIDS, and because these banks have money in the treatment of AIDS, you know, if I have somebody with AIDS, for example, they they're going to be taking medicine for the next 20 years. Why would I want to cure that? I have a customer for the next 20 years. Why would I want to take away my customer? So now you find yourself with the cure for AIDS, and your company gets short sold into oblivion, and you don't have a company on the market anymore, and your company goes bankrupt, and the cure for AIDS gets buried. Or, they get bought up by another company and it never sees the light of day again. Congratulations, you just got played by the bucket maker. As such, be wary as you invest. Understand that there is someone who controls the narrative. There is always a narrative, and there's always a narrative being controlled. Whether it says, buy Apple, it's going to go up. Well, somebody had to pay for that publicity for Apple, right? Very often it's going to be the person that owns shares in Apple already. Those articles don't write themselves. There are writers. They get paid. Those internet pages or those Reddit forums, they are very often posts that are paid for by these hedge funds, by these money makers, by this crafty blacksmith who tells you what you want. The very same advertising that's paid for. Everything has a narrative. And until you understand that this narrative is controlled by the money, until you understand that every time you look at a commercial on TV, every time you see a show on TV, somebody had to put money behind it, you will never be fully free to think for yourself. Stop, think, and understand.